Welcome to our fixed income outlook for the month of June with our CIO, Mr. Manish Banthia.
So, Manish, there has been a lot of fears around balance of payment, rupee depreciation.
Do you think that, investors are scared in the market at this point in time?
I think the right time to be scared was last year when yields were low and RBI was cutting interest rates. Sentiment was very, very bullish at that point of time. I remember in June we had come out with this note, mind the duration risk. And the reason was that when market is already discounting so much, then investors should fear at that juncture. Right now it is exactly the opposite, where sentiments are overly bearish and yields are much, much higher now. So if you compare the yields against last year, they are higher by 100 to 150 basis points in different parts of the market. So I see this as an opportunity, not as a risk for investors. And I think after a long period of time, fixed income has become very attractive for investors. So I would put it as an opportunity, not as a risk.
So, while talking about the opportunity in the market, where do you see an opportunity in the fixed income space?
I think the entire market is attractive. But specifically, if I have to pinpoint which is the most attractive part, I think the 2-year, 3-year corporate bond is the most attractive part of the market. I remember last year, the 2-year corporate bond was trading at 6.5%. Today, they are trading close to 7.88%. Last cycle, they peaked, at levels which were a little lower than where they are today. So effectively, without RBI changing interest rates, the market is already at a point which was at the peak of the last yield cycle. What effectively it means is that YTMs of all the funds in this category has gone up significantly. And YTMs is what, kind of shows performance which is yet to come. So therefore, while the past performance may not look as great, but given that YTMs are so high, the future performance from a YTM perspective looks attractive at this juncture.
So, while talking about RBI, we have an upcoming policy which is going to happen in the month of June. Any views on that?
We've maintained that RBI is in no hurry to hike interest rates. And the reason is that, we see this oil shock as one-off. And we maintained that RBI will look at the economic momentum and will raise interest rates when they feel that economic momentum is good enough for them to absorb interest rate hikes. I don't think RBI will raise interest rates because there is a balance of payment issue which people are scared about. There are other ways and means in which, that can be addressed. For me, what is important in this policy is to listen to what RBI communicates in terms of their overall stance and their overall perspective on the economy and the markets. I think that is very important. I don't think any policy action will be taken in this policy.
So, Manish, we see that there has been a lot of outflows as far as the FIIs are concerned on both sides, on the equity as well as on the fixed income side. One reason could be that that could be because of non-participation in the AI. Do you see this as a structural challenge?
I think macros in India are quite decent today. Even with the oil price change, I don't think current account deficit is higher than 2.5%, which is a very comfortable position. Capital flows, I think, are more cyclical and they're more driven by sentiments. I remember in 2024, India was, the TINA, which effectively means that there's no alternative other than investing in India. Today, it has turned the other way, where people are seeing that India has become uninvestable. I think this is sentiment, nothing else. So if I have to play sentiment, I'll be very bullish on India at this point of time, given so much of negative sentiments. And I've seen these sentiments normally turn and they mean revert. So effectively, we saw both debt markets and equity markets do very well in 2024. Normally they, behave differently. When debt is doing well, equity normally does not, and the other way around. But in 2024, 2023, what happened was both markets did well at the same time. And currency was also doing well. And right now, both markets are struggling along with currency. I clearly see that 2024 was where risk premiums in India was coming down. And today, risk premiums going up. But from a sentiment perspective, I think sentiment is an extreme. And therefore, it's a buying opportunity as far as India is concerned. So both debt and equity, look attractive at this juncture for FPIs.
So, while talking about the MPC policy, there is a lot of anticipation of rate hikes in the market. What do we think as an opportunity as far as the floating rate instruments are concerned?
So floating rate instruments are good instruments just because of the fact that spreads which is available on floating rate bond today is very attractive. If you look at some of the NBFCs which are issuing floating rate bonds today, they are issuing floating rate bonds at a spread of more than 200. Even some NBFCs are issuing at more than 300 basis points, which I think is a very attractive investment. Also because of the fact that the next move for RBI, I'm not saying that RBI is going to hike today, but the next move in the next whatever period is going to be a hike. So effectively by buying floating rate bonds, you're not only locking a good YTM in your portfolio, when the rate hikes will happen, your portfolio yields will go up. So I think it's a very attractive investment at this juncture.
Also, while talking about duration, where do you see as an opportunity for our investors across the yield curve?
So as I said, the entire market is attractive, which effectively means that even the 30-year bond, the SDLs, they are attractive at this point of time. Look, when yields go up, the market starts to flatten, and which is what is happening. In the last 2 months, we've seen that the short end of the curve has gone up much more than the long end of the curve. And long end of the curve is at a point where it becomes defensive and the carry is high. I think what will happen once the war, whenever it gets over, the risk premiums will come down. It will come down even in the longer end of the curve. So I see that as a tactical trading opportunity. So in the portfolios, long bonds, SDLs, they are good tactical opportunities, whereas the 2-year, 3-year corporate bonds should be a part of the strategic portfolio construction today.
So, talking about the positioning, could you recommend a couple of strategies in the fixed income space for our investors?
I think clearly, the corporate bond fund category, the short-term bond fund category, the banking PSU debt fund category, the floating rate bond fund category, all of these are very good categories for investors to invest today.
Thank you, Manish, for this insightful conversation. After talking to you, we believe that it's a good opportunity to look into the fixed income space for investments. Thank you very much for your time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.